All right, today we're doing a full financial health checkup on one of India's biggest banks, ICICI Bank. We're going to look at its latest quarterly report, check all its vital signs, and find out just how healthy it really is. So, you might be wondering, how do you even take the pulse of a financial giant like this? Well, the answer is right there in the numbers, specifically in its quarterly earnings report. It's really our best way to look under the hood. So, let's get into it. Here's how our checkup is going to go. First, we'll check its core pulse, profitability. Then, we'll see how strong it is by looking at business growth. After that, we'll run a little stress test on its loan health. And finally, we'll listen in to hear the doctor's prognosis for the future. Okay, let's open up the file on ICICI Bank's second quarter performance. We're getting straight to the point, the key numbers, and more importantly, what they tell us about the bank's health. First up, we've got to check the most important vital sign of all, the bottom line. Is the bank actually making money? Let's find out. And the answer is a huge yes. The bank pulled in a profit after tax of over 123 billion rupees for the quarter. I mean, that is just a massive figure. It tells you right away that the earnings are incredibly strong and healthy. And this isn't just some lucky one-off quarter. This profit is actually a 5.2% jump from the same time last year. And that's the key here. It's not just that the bank is profitable, it's that its profitability is growing. It's on a clear upward trend. So how does a bank make that kind of money? Well, a huge part of it comes down to something called net interest margin, or NIM. The easiest way to think about it is, it's the bank's profit margin on its main job, lending out money. And there it is, the engine behind those profits. ICICI Bank's net interest margin was a really healthy 4.30% for the quarter. A strong NIM like this is a fundamental sign of a well-run, very profitable bank. Profit is absolutely crucial, but a healthy bank can't just stand still, right? It needs to be growing. So, is ICICI Bank getting bigger and stronger? Let's take a look at the growth chart. And wow, the growth story is pretty impressive all around. Total deposits are up nearly 8%, and domestic loans grew by over 10%. But look at that standout number. Business banking loans surged by almost 25%. This shows the bank is really firing on all cylinders. So where is all this lending going? This chart breaks it down for us. You can see mortgages are the biggest piece of the pie, at about a third of the total. But business and corporate lending are also huge parts of the bank's loan portfolio. Now, what this really tells us is that the bank's growth isn't lopsided or dependent on just one thing. It's diversified. That huge surge in business banking is nicely balanced by steady, solid growth in its core mortgage business. That is the sign of a smart, well-balanced strategy. Okay, so a bank can grow by lending out more and more money, but that's only half the story. The real stress test is this. Are people actually paying those loans back? This is all about the quality of the loans on its books. And to measure that, we use a key metric called the net non-performing asset ratio, or NPA. Put simply, it tells us what percentage of the bank's loans have gone bad, meaning they're at high risk of never being paid back. And here's the key finding. The net NPA ratio didn't just stay low, it actually got better, dropping from 0.41% to 0.39% in just one quarter. Now, that might look like a tiny change, but trust me, in the world of banking, any improvement here is a very, very positive sign. When it comes to NPAs, the rule is simple. Lower is always better. A falling ratio, even a slightly falling one, tells us that the overall health of the bank's loan portfolio is strong, and it's actually getting stronger. But of course, no bank has zero bad loans. That's just not realistic. So how prepared is ICICI for the ones it does have? We measure that with something called the provision coverage ratio, and as you can see, it's a very strong 75%. This number is incredibly important. A 75% coverage ratio means the bank has already set aside enough cash to cover 3/4 of its known bad loans. Think of it as a powerful financial cushion that shows they're managing their risks very carefully. Okay, so the bank's current health is clearly very robust, but what about the future? To get a little glimpse, let's kind of be a fly on the wall and listen to the questions that the big financial analysts were asking the bank's top leadership. And this question gets right to the heart of it. An analyst basically asked, hey, your growth is good, but can it get even better? Can we expect you to really hit the gas and accelerate into the mid-teens by the end of the year? And here's the core of their answer. Management says they're positive about growth, but they're very deliberately not committing to a specific target. It's a classic signal of a cautious but still optimistic strategy. So, if we were to quickly write up the final doctor's notes on the bank's future, it would look something like this. The overall prognosis is positive. The strategy is all about risk-calibrated growth, which means they won't just expand at any cost. And those all-important profit margins are expected to stay nice and stable. So our checkup is complete. And the final diagnosis? It's pretty clear. ICICI Bank is a robust and financially healthy institution. It's showing stable, diversified growth, all while managing its risks with some really impressive prudence. But this whole thing leaves us with one final question to think about. The bank's focus on stability and safe, risk-adjusted returns is clearly working. But in a super competitive market, does this careful, measured approach mean it might be leaving faster, more aggressive growth on the table for its rivals to go out and grab? That's the big question.